It seems today like we have more and more people who think we can just ignore the laws of gravity, that you can print 40% of the money supply in just a few months and then have a boom and never have a bust. Yet that is exactly what people like Powell are saying when there is no more recession on the horizon. Well, in reality, there is. And I'm going to show you why the recession that is coming up soon is, number one, almost certain. Number two, it will not be a small one, but it will rival the Great Financial Crisis and maybe even the Great Depression. As of the Federal Reserve's latest meeting, they are saying that they are no longer seeing a recession on the horizon. They cite the resiliency of the economy, despite the fact that a few banks failed earlier this year. Now, the Federal Reserve is definitely not alone in anticipating no recession coming soon. In fact, analysts from Goldman Sachs are now saying that the yield curve inversion is also wrong about a coming recession. Now, the yield curve inversion is an extremely reliable indicator of a recession coming up in the future. Sometimes there are yield curve inversions that are not followed by recessions, but we haven't had a recession that isn't preceded first by yield curve inversion. And looking at the inversion of the 2 and 10-year yield curve, this is the most inverted it's been since 2000. Despite that, analysts like Edward Harrison are saying that they are not predictive of a recession. Instead, they're predictive of the Fed's reaction to incoming data. Now, this is partially true, but it ignores the fact that yield curves were inverting before recessions prior to the market's anticipation of Fed intervention. And the reason is because in a recession, when people don't have enough money to spend, they stop buying things, prices start to collapse, the savings pool is built back up, and when money becomes abundant again, yields go down. And so in a completely free market, the price signal sent by the money supply, even if it's not being manipulated, a free market money supply, you would get an inverted yield curve because future rates would go down as a result of the anticipation of the savings pool being built up during the recession. And that right now, when savings are scarce, the money supply is low, that savings pool needs to be rebuilt. Interest rates are high because you're competing for yield. Borrowers are competing for lenders, money is scarce, but the future price drops and everything from the hard times will reverse that. So a yield curve can absolutely become inverted in a free market in anticipation of a recession. Another analyst points out that yield curves are sometimes a red herring when it comes to recession because the time between their inversion and the recession is too large to be of practical use. Now, this is true. There can be a massive range of time in between when the yield curve inverts and when the recession happens. But as we'll point out, that doesn't necessarily mean this is not helpful for investors. In fact, what we can do is we can take a look back and say, given how long it's been since our yield curve started inverting right now, and the last couple of times it took this long, this is actually more helpful of an indicator, not less helpful of an indicator. So the big brains at the Federal Reserve and Goldman Sachs are saying, hey, this time is different. Yes, the yield curve is inverting extremely steeply, but economic growth is strong. So we must have gotten the boom this time without the bust. We must be able to ignore the laws of gravity. It hasn't happened yet, so it must not be happening at all. Right? Now, we're going to come back to the yield curve because I think this is the most potent argument of what we have coming down the line here, that what we see on the horizon is going to rival the financial crisis and the Great Depression in terms of severity. But even if we set that to the side for a moment, there are a couple other things taking place right now that are building up pressure under the surface. Anticipation of a recession is one of the reasons why I like to keep some of my purchasing power stored in gold and silver. And one of my favorite ways to do that is with today's sponsor, One Gold. One of the reasons I like One Gold is because it is the lowest cost way to invest in gold, silver, and platinum. If you take a look at the premiums per ounce on gold and silver, well, right now they are running a sale, so it's actually zero. But let's take a look real quick at platinum, which is $35 an ounce or 3.7%. The alternative would be to buy something like a 1 ounce platinum maple leaf, which is going to cost you $1,064 at the moment, while the platinum spot price is $946. I don't know about you, but I'd rather pay a premium of $35 $100 than $120. A little less than 4% sounds better to me than 10%. Similarly, their premium on Switzerland gold right now is 0.8% or $20.68 per ounce, compared to a normal 1 ounce American gold eagle, which is going to run you $2,058 right now with a spot price of $1,958. So $20 premium is better than $100 premium. Or with silver, which is 65 cents with 1 gold right now, versus an American silver eagle coin, which will cost you $32 when the spot price is only 24. So again, 1 gold's premiums win with 65 cents per ounce versus $8 per ounce. Now you may be thinking that the storage fees must add up if you're buying gold, silver, platinum and having it stored, that's got to cost a lot. But compared to the alternatives, something like an ETF that you'd think would be more cost efficient, you're going to be paying 0.4% as your gross expense ratio to hold GLD, the most popular gold ETF. But your storage fees at 1 gold are 0.12% for gold, 0.3% for silver, and 0.3% for platinum, well below the gross expense ratio for GLD. No matter how you slice it, 1 gold is more cost effective, and on top of that, it's insured, it's allocated, it's segregated, and you can request physical delivery at any time. Once your stack gets large enough, you want them to send it to you, you just go into the app or on the website and you request delivery. Sign up for a small bonus with the link in the description below. Number 1, we have banks' willingness to lend to consumers falling off a cliff right now. And as you can see by this chart, and the data comes from Deutsche Bank, we see that many times when banks' willingness to lend to consumers drops this quickly, it is soon followed by a recession, which is marked by the gray bars. And in an economy that is built on debt, when debt finances pretty much everything that goes on, financially speaking, in our world, when banks start pulling back on lending and it becomes harder and harder to access financing, debt financing, it makes sense that what would follow would be a recession. This is one of the reasons why the corporate bankruptcy wave is getting worse. The United States has not seen a first half of the year with as many bankruptcies as we have right now since 2010. 2010, the fallout of when? The great financial crisis. So we looked at bankruptcies, which are already starting to accelerate at the fastest pace in over a decade. We also looked at bank lending right now, which is a signal that things are slowing down very quickly. But the most important indicator that we have to come back to is the yield curve, because yes, a lot of times the yield curve is in anticipation of what the Federal Reserve is going to do. But as we already took a look at, that's not the only factor there. It is the market telling you that it anticipates a big slowdown in the future, and the longer time goes on, the higher the chances are of that slowdown. If you were to lend money to the United States government for 6 months right now, you would get 5.5% annualized on your money. However, if you were to loan money to the government for 10 years, you would only get 4% on your money. And if you were to triple that amount of time and lend money to the government for 30 years, you would still only get 4%. It's vital to remember here that interest rates are simply the cost of money. So if wheat becomes scarce, that means that we as humanity cannot consume as much wheat as we used to, because you can only consume what has been produced. Some people would still want to consume just as much wheat, and in the bidding process for buying the remaining wheat, the price would be jacked up. So a price is simply a signal to the economy of how scarce something is relative to everything else. So prices just signal information about scarcity. So if interest rates on bonds are just the price of money, what you have to pay to get your hands on money right now, they are a signal about how scarce that money is. And so if the interest rate on a short-term bond is higher than the interest rate on a long-term bond, that's simply a signal, information being sent out by market participants that right now it's harder to get your hands on money. And in the future, it'll be easier to get your hands on money. The incentives right now are to build up the savings pool so you can access some of that yield by being a lender, and they disincentivize being a borrower because then you have to pay that high yield. But in the future, with those rates low, the market is anticipating that problem will be solved. Equilibrium it'll move the opposite direction and money will be more abundant. One of the obvious results of that slowdown in spending and the rebuilding of the savings pool is prices falling, because one person's expense is another person's income. And so if everybody is saving, that means nobody is spending. This is why recessions are often called the cure for the malinvestment. Booms are the result of an artificial increase in the money supply that leads to a misallocation of resources and malinvestments. It is waste. That's when the damage happens. The recession and the correction and the bust that follows is correcting all those prior mistakes. It is the realization of the malinvestments. It is the bankrupting of those who are wasteful of resources and do not know how to properly allocate capital and plan for the future. It is the removal of resources away from those people and transferring the ownership of those assets into the hands of the more competent. And so this is not something to fear or to be afraid of. This is something, yes, to prepare for as the one who is competent, who is going to be saving prior to, so that you have the dry powder to buy those assets when they're on sale and be that owner that asset value gets transferred to when it's on sale. As the saying goes, money is made during bull markets, but fortunes are made during bear markets. If we take a look at the Federal Reserve's own analysis of the yield curve, they look at the 10-year versus the 3-month. The more common yield curve that people look at, especially when they're looking for yield curve inversions, is the 2-year versus the 10-year. But over the last couple of years, the Federal Reserve has preferred to look at the 10-year versus the 3-month. Ultimately, I don't think it really matters since they're both saying the exact same thing right now. And that thing that they're saying is a deep inversion. The 10-year 3-month hasn't gone this low since 1981. And if you take a look at every single one of these blue bars, they are preceded by a steep drop in this spread and almost always an inversion. Putting that data together, we can see the probability of a US recession predicted by this treasury spread. It may be hard to see, but on the right side of this chart, we're all the way up at almost 0.7. The financial crisis only got up to 0.4. The dot-com bubble burst only got up to 0.4.5. The last time it reached this level or higher was in 1982. So by the Federal Reserve's own measure of the likelihood of a recession occurring as a result of their preferred measure of the yield curve, it is the highest it's been in over 40 years. And now for the final objection that we brought up at the very beginning, that there's not a lot of predictive power with these because the time frame between the inversion happening and the recession is wildly different throughout history. That is true, but it's significant because of those differences. Game of Trades recently posted a thread on Twitter, which if you're not following Game of Trades already on Twitter, you're missing out. Fantastic research there, and he showed with a few of these charts, number one, that the deeper the inversion of the yield curve, the deeper the recession afterwards tends to be. We've already seen how this yield curve inversion is extremely deep, historically speaking. And given all of the times we can look back and see when the yield curve inverted, there are only 2 times in the last 100 years where the yield curve inversion followed by the recession has had a greater time lag than the one we're in right now. The first one was the Great Financial Crisis, which took 16 months between the inversion and the recession. The second one was in 1928. The Great Depression, where there was a 1.5-year lag between the inversion and the recession. To date, it's been just about 1 year since the yield curve inverted. The only 2 times in history where it's taken longer than this for the recession to happen was the Great Financial Crisis, which was also called the Great Recession, the very deep recession, and the Great Depression. The lag on those two between the inversion and the recession were 16 months and 18 months respectively. It's also worth noting that the severity of the inversion, how steep that inversion is, predicts how bad the recession will be. And the inversion of the yield curve right now matches the one in 1928. This is far from a crystal ball. If it were a crystal ball, then everybody would know it was happening, they would act on it, and bring that forward action into the present price already. And we've already started. In markets, there's no such thing as a guarantee and there's no such thing as a certainty. Heck, there's actually no such thing as being able to know the probability of something happening. Because to know the probability of something happening, you have to be able to repeat the experiment over and over and over again with the exact same variables, nothing changing, to be able to come up with an estimate of how likely something is to happen one way every single time. And obviously you can't do that with the economy. Time only moves forward. But what you can do is analyze risk. And you can say, based on the things that we know to be true about economics, and based on the data that we have about the situation that we're in, how much risk are we facing here? Are we ignoring a giant steaming pile of risk that at any time could fall over and flood the market? And are things priced in a way where it's completely ignoring that chance? Or does it seem like the market has an unrealistically low expectation of the future, has priced in all the potential risk or most of it already? Investors are panicking, selling at rock bottom prices, making things look historically undervalued. Through that lens of risk and valuation, it is pretty clear where we sit today, with stock market indexes like the S&P 500 and the NASDAQ near record highs, ignoring a steaming pile of risk. So don't be scared, be prepared. If we have a recession, be ready to take advantage of it. For more tactics and strategies on how to make more and reduce your risk, consider joining Heresy Financial University, my membership program where I teach people advanced investing strategies through the eyes of real economics. Link in the description below. As always, thank you so much for watching. Have a great day.